Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. This is our last podcast of 2021, and we decided to take a look back over the year and give you 5 excerpts from some of our favorite interviews. And we picked 5 that we thought represented the diverse array of the different types of guests that we've had throughout the year. We'll hear an excerpt from each of the following people: Market Wizards trader Chris Camillo, cryptocurrency guru Eric Wade, technology and money philosopher George Gilder, my old friend and mentor Bill Bonner, and Wall Street Bets Reddit forum founder Jaime Rogozinski. Lots of great stuff today, representative of all that we did in 2021 and really all that we hope to do in 2022 as well. We hope to find more great guests like these, and maybe even some folks who are from different sectors and represent different types of opportunities, maybe even some folks who are not even financial people. So for now, let's check out these 5 excerpts from some of our best interviews from 2021. That and more right now on the Stansberry Investor Hour. We're going to start out with Chris Camillo. You may recall that Chris Camillo is one of the traders covered in Jack Schwager's latest book, Unknown Market Wizards. And when we talked with Chris, we talked about how easy he found it to trade during the COVID crash and throughout 2020, which was not an easy year for most people. We also talked about the influence of Peter Lynch in his life and how that helped him to learn to spot trends earlier than other investors. Chris is one of my favorite guests of all time. He's a great investor with a fantastic track record. Give this a listen. Chris, you're like the one and only guy. I interview a new investor every single week. You're the one and only person who says that it was easy last year. Like, nobody says anything remotely close to that. They're like, the worst year of my life. It was really hard, blah, blah, blah.
Well, I mean, as an investor, like
Sure.
I'm just saying, to trade the market. If you look at the trades, they were all hyper obvious. There's nothing hard about realizing that everybody's buying bicycles and everybody's getting pets and like all that stuff. The printer trade. I mean, like, I traded Hewlett Packard. Oh my gosh, the printers are sold out everywhere. Surprise! I mean, you don't have to be a Wall Street analyst to figure out the cheapest printer you can buy is $430 because literally every single printer in the world is sold out. Oh my gosh. Guess what did well? Webcams. How did we ever figure that one out? I mean, God, I'm an investing genius. I figured out that webcam demand was up in 2020. This is stuff that, quite honestly, if you're stuck, and this is why I'm just so pro what I do, like in terms of being a social arb investor versus being a technical or fundamental investor. If your head is stuck in financials, or if your head is stuck in charts, you're not going to realize that everybody's buying webcams and it's right in front of you. Right? It's not that hard. Logitech, man, buy Logitech, right?
Yeah. I mean, there is one thing, Chris. There is one thing. The one thing is this, like, you might just be understating just a tad how utterly important it is to answer that one question that Howard Marks, the investor, what he would ask is, who doesn't know this, right? That's an important question, because if everybody knows it, you're at information parity, you might say, and, there's no trade. And I think most people they have a tougher time maybe than you do establishing how new is this trend. If they're writing about it in the Wall Street Journal, everybody's buying webcams. Does everybody know or not?
I'll give you that. I will give you that. But there was a time. There's clearly a time in each of those trades when no one's talking about it, right? And when I see no one, maybe you get a hint in a web board, like. But for the most part, like if you search for news for that stock, and you search for anything that's being written about that stock or talked about, and there's virtually no mention of it, you got to get into like a Reddit board, or like someone's talking about it on some Discord channel. But for the most part, it's just not there. Every one of these trades had a moment in time before the masses saw it. And I will agree with you, it's, unless you're doing it regularly, it's hard to develop the confidence, the conviction that you can see something before everyone else sees it. And it's not because everyone else doesn't see it, it's because other people have an issue connecting the dots as quickly.
The one old school investor you remind me of is Peter Lynch, because he always talked about, when you go to the grocery store, pay attention. What are you using? What is everyone using? What products do you like? What's new? What are people talking about? And, that's how you buy what you understand, invest in companies you understand.
Yeah.
And you sound really similar to that to me.
Yeah, so let me address that. Peter Lynch had a profound impact on me and my investing. I was a kid, in my teens when I read his book One Up on Wall Street, and it was the one thing that resonated with me, and it was the one thing that made me realize that, my style of investing had legitimacy to it, right? But Peter Lynch, if you remember, yes, he did believe that, but he was also an amazing fundamental investor. So he kind of mixed those worlds of fundamental and observational really well, and it worked so well for him for like 20 some odd years. What I do is, and it seems really crazy and odd to most people, and I'm sure it would seem odd to Peter Lynch as well. I've always wanted to meet him, and I've never gotten to meet him, but I would love to, but someday sit down with him. But I just basically do one piece of what Peter did, and I only focus on the observational piece of it. And my thesis is that if you can identify something that is meaningful enough, that is a real needle mover for a company, meaning a shift in consumer behavior, a shift in culture, a shift in technology, a shift in government regulation, anything, any type of major change, and you could connect the dots to a sector or a company that change would have a massive needle moving impact for, and you can determine that the rest of the investing public and institutional Wall Street hasn't fully appreciated that change, or isn't even aware of it for some reason. And you could also prove that there's nothing else happening during your trade window with that company or sector that's more important than that change, then that's all I care about. So at that point, I don't want to know what the stock is trading at. I don't want to look at a stock chart. I don't want to know anything about the management team. I don't want to know about the PE ratio. I don't want to know anything. All I want to know is how saturated that information is in the market, and I want to trade that. And I always say, and this kind of, people just think this is crazy for me, the ideal way for me to trade is to not even know what the stock price is when I'm entering or exiting the trade. Meaning, if I could just look at the market and look at my news feeds and look at all my information, but not see a stock price, and just buy that stock or sell it, short it, based on the information I have, and exit it when that, I say you have to enter. I invest when there's an information imbalance, and I exit the investment when we reach information parity. Okay. So if I can just keep it that pure, that's the ideal way for me to trade. Now, we all know that it's impossible to do that. No, I'm just a human, right? So I can't ignore the price. It's very difficult for me to completely ignore it. So I get sucked in, but I know I should ignore it, right?
Yeah.
So like I literally try to block out everything but what I'm doing. And it's pure. It's very pure. Does it always work? No. But I think if I stick with that's when I've done best. And I know you kind of touted, the 20,000 to 2 million. And what's so crazy is that I've generated I'm up to 40, 50 million, 60 million. It's something like that right now. Last year I generated 25 million in trading profits. And I think I've generated another 4 or 5 just this month. So it's what, and a year ago I only had a $6 million trading account, 6.5 million. It's because life, like I'm taking money out for taxes every year, and I'm taking money out for life. So that 6 million trading account was 20 million or of trading profits that is now 6 million thanks to taxes and having kids and a wife and a house and all that good stuff. But last year was insane. I mean, last year was just absolutely insane for me.
Next up is Eric Wade. Eric is a friend of mine. He's a Stansberry colleague and friend who I've known for some years now. And he is my absolute number one go-to guy on anything to do with cryptocurrency. So we need to check in with him now and then. And the last time we checked in with him, I asked Eric if he would tell us what the cryptocurrency called Ethereum solves. And I've listened to this interview a couple of times, and the very last time it just hit me that Eric said real quickly at one point, he said, that's the difference between the computer world and the real world, okay? Keeping that in mind will help you understand the explanation that Eric gives. And it's a very good explanation because he tries to keep it in very, very simple terms. But you can tell it's a technical subject. I mean, Eric he pulled off a really cool thing here. He covered a very technical subject with a very simple explanation. Give it a listen right now.
We've solved, I think Bitcoin, we've made the case, it's been made over and over again. It kind of solves inflation, as you alluded to. Let's talk about other problems that get solved. Like, what does Ethereum solve? What has been solved there?
Okay. The fastest, easiest way to answer that for me is it makes agreements not rely upon trust. And for people who may be listening to this right now thinking, what do I need that for? I used to have an analogy I loved, which was, let's say someone that you know really well, or brother, cousin, best friend, college friend, etc., comes to you and says, hey, I'm in a bad way. I need a little bit of help, but I can cover lend me 10 grand and I can cover it in a month once my property sells, or something like that. And we've all been in that position. And if you haven't, then bless you, you've lived a wonderful life. The next thing that usually happens is either you get paid back on time and everything's fine, or you don't. And with Ethereum, if I was to enter into a contract with someone using Ethereum, what they say is going to happen happens. And the only way to not perform is to overtake the power of the entire network. So when I if I have a smart contract that I say, and that's what's good about Ethereum's is it allows you to write a smart contract, and that would be like that deal I make with my friend, right? If I lend you 10,000, then you pay me back 10,000 in 30 days, kind of thing. And I get it. We're mixing the real world and the computer world in here with this, but I hope everybody has this notion in their head of the best laid plans. I can lend out money, or I can borrow money, or so. at some point, somebody has to perform on that. They have to deliver. And if it's somebody that I operate with a level of trust, brother, friend, college roommate, etc., I can get really hammered on that one, right? There's a reason that when I go to a bank, they say, I'm going to lend you the $10,000, but here's the terms and here's the paperwork and here's the contract. Well, with Ethereum, everything that happens has to have that level of contract. There is no best friend who can just kind of come by, pick up 10 grand and not sign his life away. The contracts, the if-thens, the borrowings, the everything that happens is in writing or it didn't happen, period. And in order to change that, you have to have all the parties agree or overcome the power of the entire network. So someone can't come in and say, let's go back to that friend who borrowed money from you. And when they say, a month later, you're saying, hey, you told me you'd have that money back in a month. And we've all been there, right? And if you haven't, bless you. Hey, you told me you have that money back in a month. And they say, whatever they say, right? It's, oh man, I didn't know you meant like 1 month, literally, etc. Okay, those arguments stop when it comes to dealing with the blockchain. If someone says it's going to be honest, and I know I'm biting off a big one here, but the reason why those arguments stop when you're coming to the blockchain is because if you ask me for money for a month, the blockchain doesn't write down a month. It says 30 days specifically, right? And if you agree to the terms, you're agreeing to specific terms, or it doesn't get into Ethereum network. And that's where, when I say we found ways to beat inflation and we found ways to invest solidly for people who were just planning to live out their retirement comfortably, et cetera, that's what I'm talking about. Is I'm not talking about lending a little bit of money to a friend. I'm talking about we're in a position now where Joe investor can say, I personally have never been that good at lending out money to people. But I know there's folks out there who are willing to pay 6, 7, 8, 9, 10% to borrow a little bit of money. If I can deal with this using blockchain, then I know the agreement is sound, or it doesn't get put on the blockchain, right? We know the terms, and we know the terms can't be haggled or renegotiated or changed, etc. So if I lend my college roommate 2 Ethereums on a contract that expires in 30 days, they come back to me in 30 days, period, or it doesn't happen. And there's a lot of value in that. So you got those people who are saying it's all intangible, and what's the value in that? Well, here's some of it. And imagine if you were a large trader or a Goldman Sachs or JP Morgan or somebody, right? And you start thinking, wait a minute, I'm already doing this kind of business. And if I wanted to lend some money to El Salvador or something like that, I can enter into a smart contract, or I'll know the terms going into it, and I'm scooping up some business that I'm already doing, but now I'm using blockchain technology to carry it out. And I think this is the lesson for the next year for standard folks out there is, I know there's money to be made out there. But when we get these traditional borrowing and lendings or getting between 2 people who are doing a trade, I can use blockchain to be a third party between you and your buyer or seller or something, and maybe take 50 basis points on that transaction as your third party. Now I'm starting to talk about stuff that Dan Ferris is thinking, wait a minute, like a market maker, or like I could be an escrow agent, perhaps, right? All of these old school businesses that the service provider made a little bit of money off of 1,000 times a month. Now we have blockchain technology to carry that out. And I'm finding ways to scoop some of that up, and investors who have money that they're willing to put aside for a little bit can make money using blockchain technology to get in between these, right? The lendings, the market makings, stuff like that. We can get in between these and make 50 basis points on our money all day, every day. And if you do that, hey, some of the things I'm recommending, we're making 5 basis points, but we're doing it 1,000 times a day, every day of the year. That adds up, right? You can make a living off of that. And in the environment we're in, where Treasuries 1.5%. All right, I get that wrong. What is it today? 1.4, 1.6, 1.5%. Junk bonds 2, 3, 4%. Who planned their retirement around junk paper making 3 or 4%? This is ridiculous. So that's why we're looking at blockchain, is because we know there's opportunities out there, and that's what that's really what we just launched. Was this is inflation 5%, junk bonds 3, 4, 5%. That's not right. You used to be able to make a spread between inflation and junk bonds.
This seems really hard to me, is what I'm getting at. It seems really hard. But are there principles? Like, do we have any? Are there any simple principles that can help me, cut out the 8,000 cryptos that I probably shouldn't be looking at, or something? Like,
there are, and the first step everybody should take is try to make it look and feel and act like a stock. We don't have boards, and on most of them, we don't have earnings announcements. We don't have even general accounting, let alone revenue or profits or any of those. And a lot of that could be because cryptocurrencies don't want to look like that. So that's your first step to take, is think of it as structured as a computer person's creative mind can go. And they have to behave specific ways to fit into computers working with them, so they're digital, etc. But we're even trying to bridge that gap now. I don't want to go too far off on the side on that, but so they have to have that much structure of being, can I computerize this? Can I digitize this? Can it be something that I can pass around over the internet, or maybe not over the internet, satellite or ham radio in some cases? And that's pretty much the only restriction. So it doesn't need to have all of these aspects like a stock or even like a bond, where you say a maturity date and what assets back it up, etc. Things like that. Can have some aspects like a real estate, limited supply, etc. Or maybe not. Cryptocurrencies, some of them have limited supplies, some of them don't. So a lot of people tend to think of it a little bit like gold type properties, because it's hard to pin down, well, is gold an element, or is it a currency, or do we use it for jewelry, etc. So that one seems to have a little bit of staying power, in that gold is a little harder to define exactly what it is, and cryptocurrencies are similar to that. But then when I'm looking at, those are the broad strokes. When I'm looking at what it is that makes something interesting to me to invest in, I start looking for users. I start looking for a use case. Like, what does this do? Who needs this? And that's the first test that I try to match, is there a use and users that are going to want this? So that's why, that's how you turn the corner from something that's the first half of our conversation today, exciting and interesting and anything can happen. And then you turn the corner towards, well, can I use this technology for solving a problem and being a good investment? So yeah, when you're trying to turn the corner into making it solve a problem and be a good investment, that's where I come in. Is I say, okay, I've got this amazing technology that maybe I can solve inflation for people, for example. That's what we're going to be that we just released last night. Is we've come up with ways to turn this anything can happen technology into solving inflation, or into solving for people who have real needs in their investment portfolio.
This is your meltdown warning coming from my long-term colleague, Dr. Steve Sugarud. With COVID cases still surging around the country and a historic market rally of over 100% since the COVID-19 market crash, well, no matter where you think stocks could go next, Steve is urging you to prepare for a meltdown in stocks. Now, Steve doesn't think you need to go out and sell all of your stocks right away, but he does believe it's time to make sure you have an exit plan in place. He also doesn't care what stocks you own or whose investment recommendations you follow. But please, if you don't know when you are going to sell your stocks, Steve urges you to watch his presentation totally free of charge at www.meltdownprediction.com. He's urging my Investor Radio audience to listen closely to his message. You see, the meltdown will arrive at the exact moment you least expect, which is why Steve recently put together his own plan for when he will personally exit stocks. And you should know, this same plan can work on any portfolio of stocks. If you do just one thing in 2022 to improve your financial health, let this be it. Watch Steve's presentation online free of charge at www.meltdownprediction.com. That website again is meltdownprediction.com. Next, we come to the great George Gilder. I've been looking forward to interviewing George Gilder since the day they told me they wanted me to take over the podcast a couple of years ago. And I finally met him, I guess a year and a half or so ago. And he's a wonderful guy. He's one of the great geniuses, one of the great intellects of our time, in my opinion. And he, back in the 70s and 80s and 90s, he was talking about things that have happened just in the past several years. The rise of the internet being one of them. So George has a lot of views about technology, but he also has some very important views about gold and money. And that's what I wanted to talk about. So that's what we talked about. And I promise you, you have never heard anyone talk about gold the way George Gilder talks about gold. This guy is a great intellect. This is a real treat. I hope you enjoy it as much as I did.
Well, as I read your work on gold, it seemed to me, I had always thought of time as just another of the ingredients in the cost of bringing gold out of the ground. But you've separated it into something altogether on its own and made it the most important feature of that cost. And I've just never heard anyone do that before. It's very interesting to me.
Well, Hayek really wrote that money is information really comes from Hayek. And money as a measuring stick comes from Hayek. All I did was scrutinize more closely what's the meaning of a measuring stick. And because in technology, what makes trade work around the world are all the measuring sticks in Système International in Paris, the second, the meter, the kilogram, the lumen, the ampere, all those measuring sticks that allow you to make a microchip in Taiwan and have it assembled in Shenzhen and made into a system in Tel Aviv and built into a computer. And all measuring sticks ultimately rely on a frequency. Really, the speed of light limit is the foundation of all the measuring sticks. And money is another measuring stick, as Hayek and von Mises both pointed out. And the great debauch of money in recent years is to turn money into a sovereign instrument of sovereignty. That's what people claim. This is bizarre. Money was gold which was available anywhere in the world. You could screw up your money in relation to gold and you paid the penalty. But money always had that root in gold, which derived its consistency as money from its continuity of the time to extract it. That's my thesis.
So if fiat is a bad measuring stick, we're saying, I want to immediately jump to the idea of Wittgenstein's ruler, right? Are we measuring a table with a ruler, or is the table measuring the ruler? And it sounds like, and I think that gets worse. The worse the measuring stick, I think the worse that gets. So what is it that, lots of people use dollars. They've used them for a long time. It must be okay at measuring, but if it's bad, what is it that is being measured? You see where I'm headed with this Wittgenstein's thing? What is the problem with the dollar? We think it's supposed to be measuring time. It's supposed to be measuring value, right? But what is really being measured here?
It's measuring the appetites of governments to pay off their supporters and to endow their bureaucracies and their administrative states and their communist parties and other parasites that afflict the world economy. That's what money has become. This illusion grew that it was an instrument of sovereignty. Everybody says this as if it's plausible. A monetary measuring stick cannot be an instrument of sovereignty. It's a measuring stick. It's a reflection of reality, and money. It's what's amazing to me. I have 2 points. One is the dollar and all the other currencies have been manipulated and twisted and debauched as an instrument of central banks and governments. But at the same time, amazingly, the entrepreneurs of the world have seen through the veils of money, the fogs of war, to actually continually advance technology. And technology is continuing to advance. And all these indices that you read about in the newspapers and that are calculated by huge buildings full of economists in Washington and New York and around London and around the world, these purchasing power parities, these inflation adjustments, these GDP deflators, these CPIs, all give way to a single concept of time prices. And the time prices show interesting realities. And measured by the time it takes for a worker to earn the 50 key commodities that sustain human life. The growth of the Chinese economy for the last 20 years has been about 12% a year in time prices, almost twice as fast as even the Chinese government has claimed. Yeah, the Chinese communists don't have any idea of the real vibrancy of their entrepreneurial economy that they're now attempting to suppress. And our economy, as well as has not grown as about a third or to a fourth as fast as China, but still it's been growing a lot faster than our CPIs have estimated. And William Nordhaus of Yale, who won the Nobel Prize a couple of years ago for his worst idea, which was taxing carbon, but he actually showed how all these efforts to measure economic growth are just vastly misconceived. When he studied the real price of light in time prices, the time a worker has to spend to light a room, from the time of the fires in the caves of the caveman, through the candles at Versailles, through whale oil lamps and kerosene, and on into fluorescent bulbs and now LEDs. The progress of light increased hundreds of thousands of times faster than any economist calculated. They just while they wrote about dark satanic mills and dismal projections of Malthusian exhaustion, technology advanced just hugely faster than anybody estimated. And the amazing thing is that continues today. So I have a upside story, but governments are really pressing the envelope today. They're provoking needless wars. They're fining and punishing leading tech companies for illusory privacy invasion and other, we're just abusing, both China and the US are now abusing their technology sector wantonly because their political power is what is their prime motivation, beyond rather than the welfare and prosperity of the world.
Well, next we have an excerpt from my interview with Bill Bonner. Bill Bonner, who hired me off the street, as he likes to say, back in November of 1997. And he gave me a job, but he really gave me a whole career and a whole life direction. And it was a real pleasure and just a real treat to interview him finally on the show. Bill had a lot to say. He talks a lot and has talked a lot since I met him about inflation and gold. And in particular, he focused on the ramifications of the Evergrande debt crisis, the Chinese real estate company, and the debt crisis surrounding that company. And whether or not we should expect a period of deflation. This is what you always get with Bill. It's always classic Bill Bonner, and a real joy to hear from him. I know you'll enjoy this. I know my listeners, and I know you'll enjoy this.
When we first got together, my first job was writing about real assets. Mining companies and the odd sort of real estate company and things like that. But really, over the long term, since then, an interesting thing has happened, at least since the dot-com crash, which happened a couple years later, after you and I first spoke. And that interesting thing is that indeed, since this century, let's just say, since 2001, gold has indeed, the ultimate real asset has indeed outperformed stocks.
Yeah.
Roughly 2-1,
right,
if you measure by the S&P 500.
Right.
So, nice call. What's next?
Yeah, that's a good question. And I don't follow it really enough to know, but everything surprises you. If it didn't surprise you, it really wouldn't be very interesting. So everything surprises you. And what now? It looks like we're coming on to a period of intentional, disastrous, government-driven inflation. So you'd expect gold to sense, like animals before tsunami, you'd expect it to be heading for high ground. And it's not. So it's not really moving that much. So you have to wonder, well, is your theory wrong? maybe that's not the way it works. Yeah, or what? And right now I'm still in the or what stage to that, because I don't really know, except that when gold moved up so much in the first decade of the 21st century, it developed a powerful base. And I've been thinking about this too, the way this Evergrande thing is in the news, by the way.
Right.
And the Evergrande story is very enlightening, because Evergrande invested very, very heavily in probably the surest thing in the world, which was that all those Chinese people who'd come from the rice paddies, they needed places to live.
Yes.
And the economy was booming, their salaries. I just saw the numbers in 1990. I think the GDP per capita of China was about $390. Now it's $10,000.
Wow.
So the purchasing power of these people who came from the rice paddies has gone way, way up. And Evergrande, correctly seeing this trend, borrowed money from just about everybody in order to build a lot of apartment buildings. And in fact, they actually sold something like 1.2 million apartments that they never built. They planned to and they promised to, but they haven't done it yet. So in this story, you see all the elements of a real boom bubble situation, of correctly seeing a trend, correctly investing for it, overdoing it, becoming irrationally exuberant, taking on too much debt, and then the bottom falls out and they can't pay the debt. So, but what happens then? So I take this as kind of a story that will help us understand what would happen, say, to the whole U.S. economy, because it's essentially the same thing. We're getting a lot of money. And by the way, the source of the money was the same. The ultimate source of the Chinese bubble was the U.S. government taking away gold-backed currency and replacing it with a currency that they could produce at will, which had the effect of increasing Americans' purchasing power on the world market so they could buy Chinese goods, and then the money going into China, ending up in U.S. Treasury bonds. Anyway, it's a long story, and we don't want to bore you and your listeners with it, but the source of the money is the same. And so now we see if it blowing up in China. And my guess is this blow up is very similar to the blow up in Japan in 1989. There too, they had gotten a lot of money in by selling a lot of product to a lot of foreigners, and they had used that money in very similar ways. They used it to create additional industrial capacity. Those huge Japanese firms were just turning out all kinds of things, cars, TVs, and everything. And China playing pretty much by the same script, taking in all this money, borrowing more money, and investing in capital development projects like 50% of its GDP or some number like that. It was just a phenomenal number at one point, unbelievable number. And when I went there, last time I was there in 2014, you could see it. It was all over. The buildings, empty buildings, all over, highways with no traffic on them, trains with no passengers in them. The capacity was huge, huge, huge. All right, so now we get to the end of that trend. We get to the point where that kind of blows up. And people look around and say, well, where are the customers? Where are the revenues that you're going to use to pay this debt? And by the way, Evergrande promised investors 11% return. 11%. Where were they going to get 11%? They had to sell a lot of apartments, which they didn't sell. So now it blows up. So what happens? Well, like Japan, and I should say also like the United States in 1929, very similar. An economy which was the growth story of the world, producing automobiles like crazy, ventilator fans, refrigerator, all these things that the people didn't
radios
before. Producing in huge quantity of these things, and then the 29 crash comes along, and what happens? Well, in Japan and in America in 1929, deflation happened. Deflation happened because they had invested hugely in capacity, and then all of a sudden they didn't need the capacity. They didn't have enough buyers. And my guess is that's what's going on in China now, a deflation in prices for apartments, really, because that's what they built. They built enormous, and malls and cities and all those things, trains and all those things that they built, they overbuilt. And now you'd expect a deflation in prices. But in America, we don't expect a deflation. And so we have to wonder, is that idea wrong? And what is gold telling us? Is gold telling us that that idea is wrong? Is it telling us that we in America, year 2021, are not that dissimilar from China 2021, Japan 1989, US 1929, that we should expect a deflation? Well, I think that, yeah, it is different, because while the Evergrande and the Japanese and the Americans in 1929 were investing huge amounts of money in capacity, America wasn't. That whole time, since we last saw each other, that investment in America has mostly been in stock buybacks. It's been in cryptos, or it's been all over the place. The tech stocks are just phenomenal. But it's not been in capacity. We don't make things. We don't have that problem. And by the way, housing has gone way down. The construction of housing, I saw this one amazing figure where in the 1950s, we produced, I think I've got this right. The US produced 6 million new houses. And in that was the 1950s. In the 1960s, it was maybe 7 million. In the 1980s, it was maybe 8 million or something or other. And now it's something like 900,000. I mean, I've got those figures wrong, but the sense of them is correct, that we now produce a fraction of the houses that we produced 50 years ago. So it's not that America has overdone the house thing. We haven't overdone the house thing. And by the way, industrial net capital investment has gone down, which is the opposite of China. They were producing stuff, goods and services and apartments and everything. We were producing money. Now, guess what I expect? Dan, you can jump ahead of me, but I expect their apartments are all going to be marked down. Our money is going to be marked down. That's what we've been producing, and it shows up in speculative investments, not in industrial capacity, not in houses, not in the things that we would normally, after a period like this, expect to be deflated.
Today, I want to bring up Matt McCall's exclusive interview. He recently filmed this for everyday investors. And since I'm the host of Investor Hour Radio, I want you to learn more about Matt and what his presentation is all about. Matt has decided to step forward with some much needed clarity on the markets and a huge prediction about the stock market that most media outlets are completely overlooking. As the world goes crazy for speculations, thousands are turning to Matt McCall for his latest thoughts. As usual, his prediction is not what you'd expect. Matt says, there's a big lie infiltrating the mainstream financial media right now, and I'm hell-bent on exposing it. Matt believes we're at a pivotal moment in financial history where fortunes will be made and lost. But the right story about exactly how to make money in the stock market today is not being told. So to get the story out, Matt McCall went in front of a live audience to reveal likely the best way to make money in America right now and exactly how to position yourself properly. During the presentation, you also get the name of the number one stock Matt McCall says to buy right now. The last time he gave away a free recommendation like this, it soared over 300%, so you want to pay attention. To watch the exclusive interview, free for a limited time only, visit www.messagefromdan.com. The website again is messagefromdan.com.
Finally this week, we'll play an excerpt from our interview with Jaime Rogozinski, the creator of the Wall Street Bets Reddit forum. This forum became very popular, especially earlier this year, due to the meme stock phenomenon, stocks like GameStop and AMC Theaters, because those stocks really became super popular primarily because they were popular on the Wall Street Bets Reddit forum. And then they caught fire elsewhere, and of course, you know what happened next. They went straight up and they bankrupted the people who were selling them short. Well, they put one hedge fund out of business and they made life very difficult for another one. They didn't bankrupt them, but they sure made life difficult. And it was really great to talk with the guy who created the Reddit forum and understands the dynamic of it better than anyone. I know you'll enjoy this. I certainly did. Give it a listen.
This sounds very cool to me. You know, you're openly saying, I want to take some flyers. You know, I want to do some trades and I want to have a little community where we don't take ourselves too seriously. But the reason I asked how long did that last is because obviously, like, and you tell me, was it really overnight? Because it seems like overnight, I never heard of Wall Street Bets before GameStop in January. What was happening before that? Had you achieved any notoriety? Had it grown substantially?
Yeah, you know, it was an overnight, whatever word we attached to it when GameStop happened, right? It became very public, very visible, and the world found out about it, the world outside of finance. Prior to GameStop, the world of finance knew very well who we were. You know, we had been featured on the cover of Business Week magazine, which is owned by Bloomberg, about a year before the GameStop. And we had been covered maybe 6 months before that all over the news for pulling similar maneuvers. So if you look at GameStop, not as a short squeeze, but as an inefficiency that was exploited or arguably created in this case, meaning the inefficiency was created. That's not something new to Wall Street Bets. It's retailers saying, I want to make some money. I want to have doing this. I want to have fun doing this. And this is my idea. Guys, what do you think if we do this? And we've seen some really crazy things. In fact, if you go to Wikipedia and you look up box spreads, right? Box spreads is like an option strategy. There's a dedicated section of Wall Street Bets inside of that article because one individual who learned about box spreads in their finance class are like, these things, they're too complicated to explain now, but in theory, it's this delta neutral options thing where you buy and sell and do crazy things. And it's
a risk-free trade.
There it is. That's the key word, right? Risk-free tree. And this guy goes, you know, Mr. Professor, why is it risk-free? Nobody's doing it. And the professor's answer was, well, if you wanted to do this, the thing that's not factored in is commissions. Commissions cost a lot of money to have to buy and sell puts and calls, and that's going to eat the little profit that you get risk-free. So this guy turned around and said, Robinhood doesn't have commissions. So he decided to do this risk-free trade and learned the hard way that in textbook, finance does not necessarily translate to the real world, because he ended up blowing his account and then another $57,000 past it.
Yeah, and wasn't that guy's original account, it was like $5,000?
It was. You actually know that story. That's good. Yeah. That's exactly what it was. And what's funny about this, he had $5,000. And then after his trade began, he withdrew $10,000. So he made profit and then it blew up.
That sounded crazy to me because, well, actually, the way you explained it makes sense. But the way I read the story, I thought, how was he allowed to withdraw the $10,000? But obviously, you got the order right. The original story I read did not. And from that point on, what did Robinhood say about box spreads?
Robinhood sent out a mass email to all of their clients saying, we no longer allow box spreads on our platform. So this individual single-handedly banned this maneuver from their platform.
Yeah, one guy claims to have had like $1 million position on a $4,000.
That's correct. Actually, that was the version 2 iteration on that. So we get the box spreads thing that happens. I lose track of time, somewhere around 2018. About a year later, someone decides to kind of modify that theory and add the fact that you have margin, because the first round didn't have margin. And they took out $1 million position with $5,000.
I mean, well, you know, look, anybody can make a mistake, but wow. I mean, I just, either that or I'm stupid. I feel like I'm a little stupid because I can't find those glitches. You know, I have all these online accounts and I'm like, you know, even when I think all the numbers are lined up, they still won't let me do the trade. But gosh, what a crazy
Yeah, I want to say what a crazy 9 years you've had, but the 9 years wasn't crazy. It's just the 1 month, really. January of 2021, right?
I mean, I think the climax could be interpreted as, at least I'm guessing that's the climax. Who knows if it will or won't be, because I don't cease to be amazed by it. But no, it's this progressive thing, right? You start off with newsworthy story about how some underage 17-year-old using his parents' account from high school, taking $900 or $1,000, turning it into $55,000 in a period of a week. That's huge news. How did this guy do it? He's about to go to college. This is great, blah, blah, blah. And that was buzzworthy at the time. And it was. It sounds like a great story. And then as years go by, then you start seeing different things that happen. And so I start becoming kind of accustomed, and people start becoming accustomed of, what's going on Wall Street Bets? This guy took out $1 million margin YOLO trade with 5,000 collateral. What's happening today? And they're like, well, it's a Tuesday, right? Like this is what happens on Wall Street Bets. They're constantly on the lookout. And to your point, it is very sophisticated. People that wanted to copy this infinite margin, this free money cheat code, it requires some pretty important knowledge of the mechanics of all these components to pull it off right. It's not just, hey, click this button over and over. It's you got to pick a stock with these properties and this, that, and the other. And so that's when, even though they use memes to express themselves and they call themselves the generator or apes or whatever it is to self-deprecate, they're actually quite sophisticated.
Yeah. Interesting. They hide their sophistication very well, I have to say.
It's they do the opposite. So you have this veil of sophistication for the, let's call them insiders in Wall Street. These are the talking heads that work at some of these big investment banks or are on TV all the time and say, this according to blah, blah, blah. And they use really multi-syllabic words to make it seem complicated, which it can be. It doesn't make them wrong, but it's just this artificial barrier of entry into, you could try this, but you're going to lose your money. They've taken the opposite approach and saying, we're dumb, but look what I just did. Right? Like, can you do that? I didn't think so.
I kind of like that better. I mean, it's like, you're smart, but I'm rich. It's like, if you're so smart, why aren't you rich?
That's a really great example. During the pandemic, when the whole world gets shut down and everyone's flocking to the stock market, there was a couple of really fun, notable examples. One is Hertz, the rental car company, declared bankruptcy, and their stock started to plunge. And then you see people on Wall Street Bets saying, well, you're supposed to buy low and sell high. Hertz is pretty darn close to zero, so that's low, right? So it can only go up, right? Very sound logic, believe it or not, it worked. So many people went to buy it that the stock, went up hundreds of percents. I don't remember the number. The stocks went up by so much that Hertz went to a judge and said, hey, judge, these maniacs, and put it in the, request. He said, these maniacs are buying the stocks because they think it's funny. But if we were to do an additional offering right now, we could actually pay off our debtors and get out of bankruptcy, right? The judge said yes, but then FINRA said no. But the people made money because the stock went up. The other example, which is really cool too, when they announced everyone's going to be locked down, people said, all right, well, the new way that we're going to work is going to be through teleconferencing and Zoom and whatnot. And so they all ran to a company called Zoom, whose ticker symbol is ZM. However, as luck would have it, there was another company that was also telecommunications that had the ticker ZOOM, the word Zoom spelled out, so that people that go open their broker and they would search the search bar for Zoom, they didn't realize they were actually typing a ticker symbol. So they invested a ton of money into this thing, and the stock the stock price shot up. But you had the sophisticated observers that were correctly criticizing this entire thing, saying, haha, you children don't know what you're doing because first, your investment thesis is wrong. Just because a lot of people may have to use Zoom does not make it a sound investment, right? There is a situation in which they have a unit economics where their per user is actually negative. You don't know where they are on their J curve, or if they even have a J curve. So your logic is wrong. Because of demand that goes up does not mean that
the fundamentals are wrong.
The approach is wrong. And the second thing is you're buying the wrong company, right? And so these guys are like, yeah, so even if I bought the right company, I'm making more money with the wrong one because it was a smaller cap company, so the price was easier to push up. So they made more money being wrong, but like they're like, if the name of the game is making money, then who's laughing?
Well, I hope you enjoyed those excerpts as much as I did. I had a great time just listening to them all over again. And what we heard there, it was really a good range of the type of guests that we have, right? George Gilder and Bill Bonner are very philosophical type folks. They have a lot of big ideas and frankly, some very deep insights into financial markets and into the topic of money and inflation and gold. Eric Wade, of course, is, he's a cryptocurrency guru. And I don't ever want to really try to dig into anything about cryptocurrency until I talk with him. And I think this excerpt kind of showed off his ability to explain complicated technical subjects with simple language. And of course, we couldn't fail to include an excerpt from some of the incredible investors and the great traders. And that's why we had Chris Camillo. He was a pleasure to talk with. He's not like anybody else we've ever interviewed. His style is not fundamental. It's not technical. It's, what he calls social arbitrage. And so I think that was a great one to include because it's a style of investing that I think is going to become a lot more popular. And in some ways, it's a lot easier and a lot more intuitive. And so I think a lot of people are going to benefit from it, starting right about now. And of course, Jaime Rogozinski is a guy with a wonderful perspective on a crazy phenomenon. We live in these very interesting times. The markets are highly influenced by rampant speculation, and it was really great to just drill down into some of the dynamic that preceded the run-up in the meme stocks, the first meme stocks anyway, GameStop, AMC Theaters. Great to talk with Jaime, and great to do it in Las Vegas. We talked with him in Las Vegas at our Stansberry annual conference, and it was a lot of fun. All right, that's it for this week, and that's it for this year. Have a great holiday, and I just want to thank you from everyone at the Stansberry Investor Hour for listening every week. You make this possible. If you didn't listen every week, we wouldn't be able to do it. And so I thank you very much. We have a fantastic 2022 lined up. We've got a lot of guests that we're going after that I think you'll find very interesting. Great investors, financial philosophers, money gurus, all kinds of people that we're going to get on the show and talk with, just like we did in 2021. So once again, thank you from the bottom of my heart. And that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody who might enjoy listening to the show, tell them to check it out on their podcast app or at investorhour.com. Do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. Have a guest you want me to interview? Well, drop me a note at feedback@investorhour.com or call the feedback line at 800-381-2357. Tell me what's on your mind and hear your voice on the show. Till next week and next year, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network. The
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.